The title of this course is Financial Management. Before we delve into the details of the techniques of financial management, it's worthwhile to discuss what the goals are and what the functions are of financial management. To start with, let's talk about how finance interacts with economics and accounting. In a sense, finance lies between economics and accounting. This can be seen in the structure of how universities position finance. In many universities, finance may be housed in its own department within a business school, for example, but in other institutions, many of which don't have business schools, finance is a component of economics and is taught as part of the economics curriculum. In other schools, finance is actually housed in the accounting department. So finance fits well with both of those disciplines. Now, the reasons for that, economics provides a structure for making decisions in various areas, and we typically think of economics as studying the use of scarce resources where there are alternative uses for those resources. What resource are we interested in finance? Well, typically money. There's usually not enough of it. Firms have multiple projects that they would like to fund, but they frequently don't have enough capital to fund everything. Likewise, shareholders and bondholders want to be paid. Bondholders have to be paid by contract. That requires money. Shareholders want to be paid dividends. What's the point of owning a stock if it's never going to generate any income? So they want income. These are drains on the cash available for the business as well. So what does the business do? Well, it may very well look to banks or other suppliers of credit or of funds. So what we're interested in finance, as it relates to economics, is we're interested in dealing with the scarcity problem that exists for cash, for money. How do we find it? How do we best deploy it, given that there are many alternative uses for the cash? Accounting, in contrast, accounting is frequently referred to as the language of business, and that language typically results in three important documents that are produced by business organizations: income statements, balance sheets, and statements of cash flow. Now, the income statement really details the profits that occur over some period of time. Balance sheets, in contrast, are concerned with the level of assets, the level of liabilities, the ownership of the firm at one point in time, typically at some year end or period end. The statement of cash flows is the more recent of these three, and it really focuses on the fact that the income statement and the balance sheet don't adequately reflect the cash flow issues that companies confront. Many companies have gone, believe it or not, many companies have gone bankrupt, not because they didn't have sufficient assets. They had more assets than liabilities, but they didn't have enough cash to meet their payroll or to pay off creditors in a timely manner. So that became an area of concern, that the cash flow situation of companies wasn't necessarily well reflected in the financial statements, and so now there's a statement of cash flows. In summary, what finance does is really links economic theory, these concerns over how to deploy scarce resources, with the language that accounting brings to us, the numbers from accounting. Now, students are frequently concerned with, well, what are the career opportunities that spring from finance? And so here there's a short listing of careers that require a strong knowledge of finance. Banker, stockbroker, these are probably well understood by most students already. financial analyst, what does a financial analyst do? Well, a financial analyst uses financial valuation methods to attach values to particular firms and thereby make determinations as to which assets might be, or firms or projects, which projects might be undertaken, which firms might be purchased, whether a firm is a good credit risk, that sort of thing. Portfolio managers are concerned with putting together bundles, referred to as a portfolio, bundles of stocks or bonds or other assets in order to minimize the risk of the overall bundle, the overall portfolio. So there's a great deal of science involved in putting together low-risk, high-return portfolios of securities, and that's the job of a portfolio manager. Investment bankers are the people who sit between corporations who need to raise money and investors who have money. In many cases, corporations know they need money, but they don't necessarily know exactly who has it or exactly what the people who have it are looking to invest in. Corporate managers really know how to run their businesses, but their business, for the most part, doesn't include on a day-to-day basis going out and raising money. Those things are done more periodically, and so they look to investment bankers to help them in that process. Investment banking has typically been viewed as a very lucrative business. Just having the contacts, knowing the right people, is sort of the job of the investment banker. Investment bankers also are involved in creating new financial products to meet the needs of corporations and of potential investors, to find better ways to match the risk preferences of investors with the opportunities that exist in corporations. Corporate finance officers are involved in running sort of day-to-day financial decisions of the corporation, picking which projects a firm might undertake, managing the cash that the firm has on hand. Likewise, financial consultants, in many cases, one of the things financial consultants may do, obviously this is a very broad range of activities, but one of the things financial consultants do is assist corporate finance officers in making those decisions. Finally, on this list, we have personal financial planners. Personal financial planner is an individual who assists investors, in particular other individuals, who want to plan for retirement, who need to insure against potential job loss or death. So they help with insurance issues. They help with borrowing, identifying what prudent borrowing is, how to go about borrowing at rates that aren't exorbitant, basically how to organize an individual's financial life. So these are all areas that require a strong knowledge of finance.